Imagine a financial institution that just, completely doubles its business capacity. They reach 157 billion rupees in assets, and they expand across an entire country.
All without opening a single physical branch in, 6 years?
Exactly, 6 years. Today, we're looking at how a traditional Sri Lankan finance company basically replaced its brick and mortar infrastructure with artificial intelligence.
Which, honestly, it challenges the core assumptions of banking. I mean, we are conditioned to think that growth requires pouring concrete and hiring armies of tellers, right? But the data we're looking at today presents a completely different architecture for scaling a financial business.
Right. So, welcome to a new deep dive. I'm excited for this one. Our source material today is a stack of annual reports spanning from the 2020 to 2025 financial years for Citizens Development Business Finance PLC.
Commonly known as CDB.
Yeah, CDB. And to evaluate their strategy objectively, we are going to run their numbers through the lens of legendary investor Philip Fisher's 15-point stock checklist.
It's a great framework.
It is. Our goal here at OptiVest Investing Sri Lanka is to equip you, the retail investor, with a forensic understanding of how this company is morphing into a techfin entity. And we want to see if their underlying financials actually justify that label.
Because before we even look at the balance sheet, we really have to establish the specific terrain CDB occupies. They operate in this distinct middle ground.
Right. They aren't a traditional commercial bank.
No, they aren't. But they are one of the largest non-bank finance companies in Sri Lanka. So their business model essentially functions as this massive capital conduit. They gather funding primarily from urban centers and maintain a net lending position to the rural economy.
Think of their funding model like a water reservoir. Wow. Traditional banks build these massive, expensive pipes, those are the physical branches, right, to move the water to rural areas.
Yeah, that's the legacy model.
But CDB realized they don't necessarily need to build new pipes. They just need to give every rural customer a bucket, like a smartphone app, that connects directly back to the reservoir.
That's a good way to look at it. But we also have to look at the structural integrity of those buckets, so to speak. Because when you lend to grassroots or rural economies, the immediate assumption is just, high risk.
Oh, absolutely.
But CDB mitigates this because their revenue streams are heavily reliant on asset-backed lending. We're talking primarily vehicle leasing, machinery, and gold loans.
Let's actually break down the mechanics of that risk. The reports highlight their relatively lower loan-to-value, or LTV, ratios.
Right.
So in plain English, if a farmer wants to finance a tractor worth, say, 1 million rupees, CDB might only lend them 700,000. The borrower has significant skin in the game.
Exactly. Which directly impacts another critical metric we have to watch, which is loss given default, or LGD.
How much they actually lose if things go south.
Right. If that borrower faces a crisis and completely defaults, CDB repossesses the tractor. And because the loan amount was significantly lower than the asset's actual market value, the actual loss the company takes after selling the asset is negligible.
Which is huge.
It is. This is why their weighted average yield on assets can remain competitive while their risk profile stays anchored, especially when you compare them to finance companies that are focused on, unsecured microfinance.
And this brings us to the term management keeps using over and over in these reports, techfin.
Right, not fintech, techfin.
Exactly. They aren't calling themselves a fintech. They are a traditional finance company that's prioritizing a technological disruption and a sustainability agenda, really, to redefine their legacy business lines.
And that distinction really matters. A fintech is usually a technology startup trying to acquire financial licenses. A techfin is an established financial institution. They already have the capital, the regulatory clearance, the massive loan book, and they just decide to operate with the agility of a software company.
So if they're operating with that much agility, we need to look at the actual profitability of their core engine. Let's examine their net interest margins, or NIMs.
The lifeblood of a lender.
Yeah, the baseline of any lending business. It's the spread between the interest they pay out to depositors and the interest they collect from borrowers.
And the trend line here is incredibly volatile. I mean, in the 2020 to 2021 financial year, their NIM was a robust 8.0%. The following year, 2021 to 2022, it actually peaked at 9.05%.
Wow. That is a highly lucrative spread for an asset-backed lender.
It was phenomenal. But then the Sri Lankan macroeconomic crisis hit.
Hmm.
So by the 2022 to 2023 financial year, CDB's ENIM collapsed to 7.18%.
Ouch.
Yeah. And to understand why, you have to look at the mechanics of a maturity mismatch. CDB was funding long-term, fixed-rate vehicle leases using shorter-term borrowings and deposits.
It's like a financial seesaw. On one side, you have a 5-year vehicle lease locked in at a fixed interest rate. On the other side, you have short-term corporate borrowings and customer deposits that reprice every few months.
Exactly. So when the central bank aggressively hiked policy rates to combat hyperinflation, the cost of CDB's short-term borrowing skyrocketed almost overnight.
But the revenue coming in from those existing 5-year vehicle leases?
It couldn't be adjusted, right? Their cost of funds surged, their interest income remained completely static, and that margin in the middle was just crushed.
Okay, but let's play devil's advocate here regarding their recovery. Because by the 2024 to 2025 financial year, their NIM recovered to 7.97%.
A solid bounce back.
Yeah, and the reports frame this as a major strategic victory. But the central bank literally lowered policy rates during that exact window. A rising macroeconomic tide lifts all boats, right?
Sure.
So how do we know the 7.97% NIM isn't just the dumb luck of a falling interest rate environment?
That's the forensic question, right?
Okay.
And it's easy to dismiss it as cyclical luck until you cross-reference it with their funding composition. While rates were dropping, management didn't just passively ride the wave. They actively slashed their reliance on corporate borrowings by 32%.
Wait, 32%?
Yeah, because corporate borrowings are highly sensitive to market rate spikes. Instead, they pushed customer deposits to comprise 75% of their total funding base.
Oh, I see. So they fundamentally changed the shape of the boat. Customer deposits are stickier and way less reactive to overnight policy shifts.
Precisely. They accepted lower margins in the short term to restructure the balance sheet. This ensures that the next time the central bank hikes rates, they won't be caught in the same maturity mismatch trap.
That is the big takeaway here. They sacrificed immediate yield for structural resilience, and this transitions perfectly into how we actually evaluate the people making these decisions.
Right, which brings us to Philip Fisher.
Yes, Philip Fisher's 15-point checklist. It's a renowned framework for exactly this kind of analysis. Fisher believed the numbers only tell you where a company has been. The management's philosophy tells you where it is going.
Now, obviously, we are applying a framework from the 1950s to a modern tech-fin company, but the core criteria absolutely hold up. Fisher focused heavily on evaluating management's long-term vision, their cost controls, their transparency, and the effectiveness of their R&D relative to their market size.
Let's talk about transparency first. On that front, CDB really stands out. They secured a first-time standalone credit rating of BBB from Fitch Rating Lanka.
Which is not easy.
Not at all. And they don't obscure their non-performing loans, and they meticulously report on their environmental and social impacts.
But I'd argue the most critical point on Fisher's checklist for CDB is the long-term vision. They have anchored their entire strategy on two main pillars: technological disruption and sustainability.
Okay, but Fisher also requires a company to target markets with substantial market potential. CDB focuses heavily on the rural base of the pyramid demographic. Does lending to marginalized communities inherently limit their financial ceiling?
It only limits it if you view market potential strictly through the lens of individual ticket sizes. In emerging markets, the base of the pyramid represents the vast majority of the population. It's the real economy.
Right.
Traditional commercial banks often ignore this demographic because lending out thousands of small-value loans requires heavy administrative overhead.
Yeah, paying a whole team to process a tiny loan destroys the profitability.
Exactly. But if CDB can process those loans without that overhead, that rural demographic isn't a limitation at all. It is a massive, untapped goldmine.
Which brings us to the actual machinery of how they eliminate that overhead. Because for a tech-fin company, Fisher's requirement for a strong R&D program doesn't mean inventing new physical widgets.
No, not at all.
For CDB, their R&D is entirely focused on artificial intelligence and process automation.
And we really need to unpack the actual pipeline they have built here. They aren't just slapping AI on their reports as a buzzword. They have deployed a comprehensive suite.
Let's list them out.
Okay, so they have an AI-driven credit decisioning system, an AI-based vehicle valuation engine, automated risk-based pricing, dynamic credit scoring, and AI-enhanced fraud identification.
That is a lot of engines. Let's look at the mechanism of just one of those, like the vehicle valuation engine. Historically, valuing a vehicle for a lease required a human appraiser to physically go inspect the car, check the market papers, and make a subjective judgment. How is the AI actually handling this?
It operates through integrated data pipelines. So the system pulls real-time market data, it cross-references historical depreciation curves for that specific make and model, analyzes market liquidity for the asset, and computes a valuation instantaneously.
Instantaneously.
Yeah. And simultaneously, robotic process automation, or RPA, handles the customer due diligence by basically scraping the required documents and pulling data from the National Credit Bureau via an API.
So the RPA acts as the administrative assistant gathering the files, while the AI engines act as the appraisers and underwriters.
That's a perfect analogy.
And the data from the reports backing this up is staggering. Turnaround times for credit decisions dropped from roughly 3 hours to fractions of a second.
Fractions of a second. Think about that scalability.
Yeah. The AI model operates at a 94% accuracy rate, and today, 75% of all their credit decisions are fully automated.
And on top of that, they utilize this forest pin-powered enhanced transaction monitoring. It acts as a real-time surveillance system. It identifies anomalous transaction patterns post-disbursement to catch fraud before it actually materializes into a non-performing loan.
Okay, but looking at the raw data, if an algorithm is making 75% of the credit decisions, who is actually running the risk management of this company?
That's the million-dollar question, isn't it?
Right. Are the executives really in control, or have they just handed the keys to a black box?
The executives define the parameters of the box. The algorithm does not set the company's risk appetite. It strictly enforces it.
Okay, explain that.
So the board dictates the acceptable loan-to-value thresholds, the credit score minimums, and the sector exposures. The AI simply executes that mandate with absolute consistency, zero emotional bias, and infinite scalability. The executives are steering the car, the AI is just the engine propelling it.
But an engine like that requires massive upfront capital expenditure. Setting up API pipelines and training proprietary AI models isn't cheap. So how does this actually impact their operating expenses? If we want to measure the true impact of this technology, we have to look at the cost-to-income ratio.
And this metric is the ultimate scorecard for operational productivity. Despite the heavy investments in AI and all that macroeconomic volatility we talked about, CDB's cost-to-income ratio dropped to an impressive 48.4% by the 2024 to 2025 financial year.
Meaning they're squeezing significantly more revenue out of every rupee they spend on running the business.
This-
And this ties right back to that statistic we opened with. They reached a 157 billion rupee asset base without opening a single new branch in 6 years. They completely decoupled their growth from their physical infrastructure.
Yeah.
But, the human element of this is what surprised me the most. Usually, when a financial institution automates 75% of its underwriting, the very next paragraph in the annual report announces massive layoff.
Right, which is exactly the scenario we saw in a previous deep dive. Remember our analysis of HBS?
Oh, yeah.
Their aggressive automation drive directly resulted in a 15% reduction in headcount because they viewed technology purely as a replacement for human labor.
But CDB took the exact opposite approach. If you look at the net movement of their workforce strength over the past few years, it has remained relatively stable even as their business capacity doubled.
And that is because management's philosophy views AI as a tool to eliminate manual tasks, not people. By handing all the mundane data entry and processing tasks over to the RPA and the AI algorithms, CDB freed up their existing human capital. They redirected those employees toward complex relationship management, localized problem solving, and personalized customer service.
The exact value-added areas where an algorithm falls short.
Precisely. They took a team of administrators and essentially turned them into relationship managers.
But internal efficiency only takes you so far. You also need external customer-facing products to generate growth and bring in the deposits needed to fund these loans in the first place.
Which brings us to their digital product ecosystem. They launched the CDB Self app, which is this integrated digital banking platform. They also have the CDB iControl app, iTransfer, and iDeposit.
And crucially, they own patpat.lk. On the surface, if you look at it, it just looks like a standard e-commerce platform for vehicles and real estate. But mechanically, it's a brilliant customer acquisition tool.
Oh, it really is.
Because instead of waiting for a customer to find a car somewhere else and then come to CDD for a loan, PatPat.lk embeds the financing directly into the shopping experience.
It creates a completely closed-loop ecosystem. And we also have to look at their eShift initiative, which focuses on financing electric vehicles and renewable energy solutions, like rooftop solar.
Which directly aligns with their sustainability pillar that we mentioned earlier.
Exactly.
But how do these specific products actually balance out the volatility of their net interest margins?
Well, in two main ways. First, platforms like PatPat.lk and the eShift ecosystem generate steady fee-based income. That income is completely independent of central bank interest rate fluctuations.
Right, it's not tied to the spread.
Exactly. And second, the digital apps like iDeposit attract low-cost retail savings. This is particularly effective with younger millennials and Gen Z demographics who, they prefer managing their finances on a screen rather than standing in a teller line.
Yeah, I certainly do.
Right. And these low-cost deposits are the cheap capital CDB needs to fund those asset-backed loans.
Okay, so synthesizing all of this, we have the tech moat, the stable human capital, the recovering NIMs, and the digital product ecosystem. Let's tackle the ultimate valuation question. The management has publicly stated their target is QTAB.
A $250 asset base.
Right, 250 billion rupees by 2030. They are at 157 billion right now. Can they actually hit that target using AI as their primary growth lever?
Well, the historical data suggests they absolutely have the scalable architecture to do it. But valuing CDB requires retail investors to make a fundamental choice. If you evaluate them strictly as a traditional finance company, you see a business with a highly liquid balance sheet, low loss given defaults, and recovering profitability.
But I want to pose this question directly to you, the listener. When you look at CDB, do you price them based on the traditional multiples of a brick-and-mortar leasing company? Or do you price them as a highly scalable fintech platform that simply happens to hold vehicle leases on its balance sheet?
Because the market values those two models very, very differently. And to make that determination, retail investors really need to evolve how they read these financial reports. Evaluating a company is no longer just about calculating the static value of its assets at the end of a fiscal year.
You aren't just buying a spreadsheet of current loans, you are investing in the management's capability.
Which is exactly the point Philip Fisher emphasized all those years ago. You have to assess management's demonstrated ability to navigate severe macroeconomic crises.
Yeah.
Like, look at their strategic pivot away from corporate funding.
Yeah.
You must evaluate their execution of new technology, like automating 75% of decisions without fracturing their workforce culture. And you have to demand strict shareholder transparency. The financial ratios we look at, they are simply the lagging indicators of the management team's daily decisions.
And speaking of reading financial reports, there is a growing trend right now where investors take a 300-page annual report, dump it into a large language model, and just ask the AI for an investment summary.
Oh, yeah. That's becoming very common.
Right. And given that we just spent this entire deep dive praising AI, we need to address the danger of using it for your own investment analysis.
We absolutely must issue a very clear caution on this. Large language models are exceptional at information retrieval. I mean, if you ask an AI to find CDB's cost-to-income ratio for 2024, it will instantly extract that 48.0% figure. But AI fundamentally lacks contextual comprehension.
It's like having a lightning-fast intern who can read 1,000 pages in a second and highlight all the numbers. But that intern doesn't understand the nuance of human panic during a national economic crisis.
That's exactly it.
An AI might extract the data that corporate borrowing decreased by 32%, but it completely misses the strategic why behind that capital allocation decision.
It misses the subtle narrative shifts in the chairman's letter. It cannot weigh the timing of a policy rate hike against the execution of a new digital app launch. AI is a powerful support tool for gathering data, but it is not a sole decision maker. You, the retail investor, must act as the seasoned executive. You have to synthesize the context, apply the forensic frameworks, and make the final judgment yourself.
Beautifully said. As we wrap up this analysis of CDB's transformation, I want to leave you with a final thought to consider. We've established that their proprietary AI-driven credit decisions and their ability to double capacity without physical branches offer a massive competitive advantage today. But technology moves relentlessly.
It really does.
So if instantaneous credit decisions and branchless expansions simply become the baseline industry standard over the next 5 years, what will CDB's next major differentiator be? Will this TechFin architecture sustain their growth to a quarter-trillion asset base, or is it merely the new minimum requirement for survival in the modern financial sector?
That is the perpetual challenge for any management team pursuing disruption. The moment you build a new architecture, the rest of the industry begins trying to copy the blueprints.
This content is for educational purposes only, based entirely on publicly available information. It does not constitute investment advice, and there is no vested interest in any company discussed. If you found this analysis useful, take a moment to reflect, question the narrative, and share this with other retail investors who may benefit from a deeper perspective. At OptiVest Investing Sri Lanka, we focus on bringing clarity through data-driven analysis, and we'll be examining more listed companies in future deep dives with different narratives. Stay tuned.